Ramesh Damani caught up with Anand Radhakrishnan, CIO of Franklin Templeton, and began by asking him about his investment style and the key parameters he looks at before investing.
Currently, we are looking at more than current growth. I would say we are looking at the growth potential of that company. For example, a company who may not be growing pretty well, but doesn't require too much of capital to grow their business because they already might be sitting on excess capacity, underutilized capacities,
right.
Reasonably less, not excessively leveraged balance sheet, but we don't mind a bit of a leverage because we think that both operational leverage and the financial leverage essentially can, if things grow better into the future, you will get good growth. We don't want excessive leverage in that. So yes, you are looking for therefore companies which are slightly underutilized in their current capacity. Balance sheet may not be pristine clean because pristine clean balance sheets are anyway overrated, or that pendulum swing has taken their valuations to a very high level. So it should be reasonably clean.
I could be wrong, but it almost seems like you're suggesting commodity stocks.
Commodities might be like really a deep value. I think they are going to be stressed for some quarters at least, if not for some years, going by the way things are now. But
so which sectors? Tell me which sectors you find.
I think one is automobiles, both four-wheelers and two-wheelers. Some of the auto ancillaries definitely qualify for taking a very pro-cyclical kind of a bet into next 3-4 years. That is definite value. They are not overvalued by compared to the broader market. Similarly, we are seeing opportunities in cement. We are seeing opportunities in banks. Even if you are a cyclical investor, even one may find value in some of the PSU banks also. While I would still put a lot of my money in a high growth private sector banks. And we also can find value in some of the good utility names at this point of time.
Are you scared that if a global meltdown takes place, that a repeat of 2008 will happen?
The world is a little bit awash with liquidity. Now, clearly there is a risk to the global equity markets. When it comes to India, I think the risks are much less today than what it was in 2008.
Okay, well, that is some market opinion that you'll